Market makers are targeting your stop losses. They'll see your stop losses, and that's what they're always trying to do, target your stop losses. Any truth, any rumor in the space that they look to point fingers at.
Some of the biggest companies that do some of the market making, they are adding liquidity to the markets, but I would say some of them are predatory as well. I started 3 weeks before 9/11 as a market maker. Now, I mean, what the majority of market makers will do is...
What's it in terms of a trading plan? What does that look like? What should a trader be looking for when it comes to making a trading plan?
You see, I think there's two parts to a trading plan. The first bit is the financials. If you're just getting into trading, you've got to treat it like a business, number one. So I always say to guys,
what are your thoughts as someone who's been through these market environments before? What is it that traders should be focused on when those volatile moments are happening and when things feel like a bubble and that a crash could be happening or on the horizon?
If you look at all the good pro traders, they've got the simplest of setups. Everybody tries to overcomplicate trading. Not only that, but
the number one podcast in the trading space, the fastest growing, and that's thanks to every single one of you.
Welcome everyone back to the Words of Rizdom podcast. We are back once again, and we are still the number one trading podcast in the world and the fastest growing, thanks to all of you and our incredible guests. Talking of which, today we have a 50-plus year trading veteran with us today. Phenomenal trader who started on the London Commodity Exchange. He was actually at one point up to 30%, responsible for up to 30% of the daily coffee volume, which is absolutely mind-blowing. We're going to learn a lot about commodities today. We're going to learn a lot about trading. So make sure you're ready. We're with the one and only Chris Tubby. Thank you, Chris, for being here.
hi Riz, thank you for inviting me. I'm really looking forward to this.
Same. Wealth of experience. I'm sure that we not only are we going to learn a lot, but I'm excited to hear, especially about the 30% of the daily volume, which I'm sure we'll get into, because I know that's for a lot of people, they won't be able to maybe compute how much size that is in terms of trading. But I'm excited. But I want to start off with just one thing, which might be a good place to start, to be fair. It's a quote from yourself, which was, I was going to be an accountant. I love numbers. But when I got a job offer at the London Commodity Exchange, I thought, why not? Within 2 days, I knew this was what I wanted to do for the rest of my life. Yes. What was it about those 2 days that made you realise?
Well, it was strange. It was, because as I say, I love numbers, and I already had an offer on the table from a construction company. But I thought, I just want to see what else is out there and explore for a little bit. And I come up, sort of 17, 18 years old in my suit and all that. I walked up these rickety stairs near Fenchurch Street into this little agency, completely different to how it's all done these days. I went, got any jobs? And they went, yeah, come in, sit down. And same afternoon, they got me these interviews. And one of them was with the London Commodity Exchange. So I went in there and sat down, talked to them for a little while, and they went, when can you start? So I said, when do you want? They went, Monday. I went, oh my God, okay, let's give it a go. So then I went in there, and after sort of, because it takes you back to sort of like the dinosaur days of trading almost, because I am. So, what it was you just had this massive blackboard that went across the whole width of the room, and it had all the months coming down, and you had your piece of chalk, and when you sort of identified a trade, you would go to the month that it was, and you would put the number of lots that are traded, little bracket round it, and the price, and then you had to run up to the other end and rub out the total volume and change the total volume as well. And I was just a natural. I don't know why or how. It just all sort of worked for me. But when I was on the second day, I was standing up there on the board, and I looked around, and there's all these young lads. They're all sort of 21, 22. It used to be the directors, but the market started to get a little bit too fast for them. So we need to go back to the office now. Let the young guys at it. And they was all down there, and I just thought, you know what, this is still like being at college, but I'm actually getting paid for this. And I thought this is something that I could really take to just because of the numbers and everything. So So I phoned up the woman from the construction company. I said, I'm really sorry, I've changed my mind. And she was like, listen, best of luck to you. So, and yeah, I've never looked back since. I've really enjoyed it.
Did you see yourself sticking out for 50 years and more?
No, because I thought I'd be retired after 40.
That's true. It's the love of the game. But starting off...
Yeah, it's just the passion of it. I just love it as much today as I did even then. So
it's interesting because, of course, back then, as you say, there was such a different environment, such a different environment. Those, in those exchanges, in those rooms, in those pits, there's such an energy that you don't get now. Like it's all electronic now. Most traders don't even know other traders.
Exactly.
And that is a complete opposite of what your experience was on literally day one. So what do you think to that? How does that make you feel? Is it something that you think is a positive for the traders, or you think it's actually maybe a net negative?
I think for a lot of traders these days, especially if they're doing it from home, it's a negative because they feel that it's a very lonely experience. I mean, most of the time I've always done it sort of in either in a company for sort of like my first 10, 12 years. And then after that, when I was doing it for myself, but, I was surrounded by 2,000-3,000 people on the life floor. So, there was always plenty of people around you. But then, when it sort of did go electronic after 2000, then, there was all the trading rooms still. You just went into the office and you had all the screens and you just got into that. But I think sort of since we've had this massive influx of retail traders that it's really changed. But, a lot of my customers, they are just sat at home doing it for themselves.
What was it like first starting with trading? Because obviously it wasn't electronic. So, and it was new to you as well, because it wasn't something that you'd essentially trained for or got ready for, except for being good with numbers and loving numbers. So what were some of the hurdles that you first faced, getting into it, getting started?
Well, I was very fortunate the way that I fell into trading because I worked for the London Commodity Exchange for 18 months. And I got to know all the traders down there and talk to them, so it worked really well. And then a small brokerage company, this was in cocoa, they come up and said, would you like a job? So I'm like, well, yeah, okay, well, let's go for it. So that was the start of my sort of trading career, and I stayed with them for about 18 months, and by then I think I was about 20 and I was getting married, so I went in and asked for more money and they went, we can't do that. So I heard about this other job going, which was like for one of the biggest trade houses in the world at the time for commodities. I thought, I'm just going to go for that. And the biggest question that they asked me in the interview was, do you think you can work with Terry? Because he was a bit of a maniac. So I'm like, yeah, no problem. So they went, okay, you can start then. So, and then I went back to resign and they went, why are you leaving? And I went, well, because, you wouldn't pay me the money. And they went, but how much are they paying you? So I told them, they went, well, we'll pay you that now. And I went, no, you had your chance, that's it. Never look back. I mean, once you make that decision, that's it. So. And then I moved on. It was the best decision I ever made. They were a great company. It was like a real family atmosphere. And of course, as the traders, you was generating all the revenue. So, and then we was given our own sort of trading accounts for using the company money as well. Mine was 008. And then one day they said to me, can you go and cover coffee for a couple of weeks because Mark's going on holiday. So I'm like, all right then, I haven't traded coffee. But, in those days you had to qualify. When I first went, even off of sort of working for the exchange, I had to do 2 weeks where I could observe. I had a blue button, but you couldn't actually trade. And then you had to do 4 weeks on a red button where you could trade under supervision. And then pass. And that was really sort of when I sort of worked out that I could be a good trader, is because there was one day, I think it was about halfway through when I was on my red button, and the guy who supervises me, he phoned in sick for the day. So whether he was sick or they wanted to see what I could do on my own, okay. I don't know. So a trial. And then we had a couple of guys in the office. One of them was an old boy, but probably younger than I am now. And he phones down, he goes, buy 500 deck at market. So I'm like, okay. So I bought the 500 deck at market, gave him the fill and everything. So he's like, great. And then about 10 minutes later, he phones me up, sell 500 deck at market. I'm like, whoa, what's going on here? And of course, I'm there on my own. So I said, what's the problem? So he said, it was a stop loss. We shouldn't have done it yet. The customer only wanted to buy if the market rallied. He thought he was getting a better price, so he thought it was like a good trade. So I said, okay. So they said, okay, get out of it. I'm like, all right then, yeah, don't worry. So I'd only been trading for 2 weeks. And I just took the whole afternoon getting out of it. They're like, you got out, yeah? And I thought, no, because I'd just like sort of make the market drop if I'd come in to sell them again. So I just took the whole afternoon just selling out a little bit here, a little bit there, until on the close I was out of all of it. So that sort of, and at the end of it, you know, we lost a little bit of money, but not much, whereas we could have lost a lot more.
How was it handling the pressure going into that, you know, that environment?
I never felt any pressure. I never panicked or anything like that. Just take it as it comes. As I say, so then I got offered to go and cover in coffee for a couple of weeks. So I went in there. So I said to Mark, you got any positions? He went, nah. So he went. So I phoned up the back office on the Monday morning. I said, I'm just confirming Mark hasn't got any positions. And they went, actually, he's like long 2 lots. So I'm like, okay, what month? So I'm like, all right then. So for the next 2 weeks, apart from doing all the customer business, the company business and everything, I was just trading his 2 lots in and out. So every time it sort of rallied and I thought it was the top, I would sell it. Every time it come back down, I'd buy him back. Each day at the end, I would always leave him long his 2 lots. And towards the end of the 2 weeks, Stuart, who's the director for coffee, said, you've been trading Mark's account? I went, nah, not really. And his account was 007, so I loved that. So I said, no. I said he had a little 2-lot position, so I'd just been trading in and out of that for him. So he said, do you want a job? I went, well, I work in cocoa, you know, same company. So he went, I want you to work for me. So I said, oh. So he said, how much are they paying you? So I told him. So he went, I'll double that. So I went, okay, push me luck a little bit. Went, yeah, but the bonus is in cocoa, you know. So he went, okay, he said, I'll guarantee you 100% bonus as well.
Wow.
So I went, looks like I'm going to be a coffee trader. But our managing director, he had cocoa in his blood. So when I said, oh, guess what, I want to leave because I'm going to go into coffee because they asked me to go into there, he was fuming with me. He made me go in the rubber market for 3 months that hardly did anything as my punishment because I was a traitor because I wanted to go into coffee. But it was lovely. I mean, we used to do so much business, I say up to 30% of the daily volume. Mondays, lunchtimes, we'd go and have beer and sandwiches in the boardroom. All of us, the physical traders, the futures, the managing director used to come in, Jim, and the 2 coffee directors as well. And we'd discuss our strategy of what we wanted to do with the forward curve, because obviously with commodities and with futures, we're trading into the future, and we could trade up to a year or 2 ahead. You know, we was buying and selling coffee crops that hadn't even been grown yet at times. Yeah. And so we was doing that. So we were working out which way we wanted to be on the curve, whether we wanted to be sort of long at the front, short at the back, and vice versa. And then they would just give me like a massive order to get done during the week.
What would that 30% of volume sort of equate to in terms of whether it's contracts or in terms of volume?
Profitable trading really boils down to 2 things: opportunity and volatility. And that is why the podcast has partnered with Market Journal. Because between the years 2016 and 2020, the amount of opportunity that was available, as well as volatility to take advantage of, was at the highest it's ever been. And all of that really pointed towards one man, President Donald Trump. During his period in office, all it took was one tweet, and that would present so much volatility, and the right traders would take advantage of that and would create their record P&Ls. And that is why those same traders are so excited for this new period between 2025 to 2029, when we have President Donald Trump back in office. Now, Market Journal is going to give you the weekly insights you need across crypto, forex, futures, and the stock market. So regardless of what happens, whether it's a tweet, a particular stock running up hundreds of percents, whatever volatility and opportunity that Market Journal can identify, it is going to share with you every single week. So you can purely focus on taking advantage of those opportunities and taking advantage of that volatility to create your record P&L. Now, Market Journal is absolutely absolutely free. All you do is click the link in the description below, put in your email, and you will receive key updates on the markets every single week. So you are always up to date with what's going on and ready to execute when the time is right. Links in the description below. Thank you for enjoying this episode. Let's take a break for a minute there, guys, because I want to let you know about one of our sponsors. Alpha Futures is offering the best one-step evaluations in the industry. They have the largest end-of-day based drawdowns in the entire industry, with up to 90% profit split and lightning fast payout speeds, and offering advanced and standard accounts to fit your needs. Alpha Futures is truly offering the most elite plans for the lowest total cost to entry in the industry. You can start as low as $79. And thanks to the podcast, using code RIZ, R-I-Z, you can get 20% off any of those challenges. Go to the link in the description below, and let's get back to the episode.
Yeah, that's like sort of 30% of the traded contract volume. Yeah, so if it was, say, 70,000, I've done quite a chunk of that. But, it was up to 30%. I mean, some days I might only be 15, 18%. But, yeah, there were some days where, we used to get sort of very market-moving orders for sure.
It's interesting because you don't really hear much about, well, more so in like the social media space or in general retail traders today, focusing on commodities at all. They're mainly focused on, say, FX futures or options at most, and crypto, of course, now. So what is it about the commodity market? Is it still something that you trade today, something that you look at today as well?
Yeah, I still trade all the asset classes, and I love trading just all of them. Coffee and cocoa have had the two of the biggest rallies this year, apart from probably Bitcoin, actually, even though the stock markets have had that sort of really big move up. They're just interesting because it's a completely different set of fundamentals. There was a while when I was working in Canary Wharf in an office, and all the guys at the front of the office, they was all trading the financials. They'd all been boom bobble shats traders for years and all that, and then obviously that trade sort of disappeared. And so Ralph, who was the owner of the company, and he was an ex-grains trader from Chicago, he said, okay, and he gave them all limits to trade a little bit of commodities. But they all lost money because they didn't understand that there's a different set of fundamentals for commodities than there are for the financial markets. And, I always say that when it comes to commodities, you've got to be very cautious about ending up short of some of those. If you're long, what's the worst case scenario? It can go to zero. But, it's never going to get there because there'll always be someone that will think that there's an attractive price where they'll want to buy it from you. But you sell something you haven't got and it keeps going up and up and up. There's no ceiling to that market at times.
Plus, there's always, especially like things like coffee, for example, there's always going to be some form of demand.
Absolutely.
But one thing you mentioned just before we started in terms of fundamentals is like there was one year where the Brazilian crop had a freeze, or was essentially the entire crop was gone. And then that impacted the market massively. And then obviously that's quite an unpredictable, in a sense, sort of fundamental data that will come out. Especially at that time as well, in terms of now, like the speed at which data can get across the world is so fast. It's like almost instant. But back then it could have been like trickled through the markets to get to you here. Were you trading commodities here when you were in London?
Yes, right? It was all in London.
So it would get from Brazil to you. By the time that's happened, it might have gone past through America, for example. You might be getting whispers of it. What does that sort of event look like?
Well, we used to actually pay a guy, his name was Don, to travel the world, a terrible job, and just go to, Africa, South America, literally all around the world, because, this is going back into the 70s, so we didn't have all the wonderful satellites and everything that we've got today. His job was to go and talk to the farmers, look at the weather, talk about the crops, and then send us reports. And that's all he did all year, every year.
Wow.
That was his job. So that's how we used to get our feedback. And as I mentioned before, is my old boss, his philosophy was, if you're bullish, you can buy as much as you want. If you're bearish, just buy less. But he was a massive bull trader. And he was so fortunate because he was pretty much long of every ounce of coffee in the world when that happened. And the price went from £400 a tonne to £4,000 a tonne.
Was that in the space of a certain time, or was that pretty rapid?
Yeah, it was pretty rapid. It was within sort of days to weeks to months. I mean, the ranges each day were just absolutely crazy.
Do you feel like the volatility in commodities though has sort of simmered down in comparison to when you were trading originally?
In most years, yes, but if you look at this year, as I say, coffee and cocoa have had two of the biggest moves of any market.
What was it? What was the catalyst in this?
It's the
particular
same
year?
sort of things where weather was impacting the crops. There was some disease. It was all just the sort of like the normal traditional stuff that can impact them. But of course, the other things you have to consider with sort of just actually any sort of goods that you're transporting. Then you've got to start looking at sort of the wars and the impact that, when Russia invaded Ukraine and you saw oil go up to $130, you saw a lot of the agricultural commodities, because they're big exporters, so they're just going up and up and up. And of course, in the Middle East there, we've got problems as well. So it's very difficult for the ships to come through there. So they all go around Africa, which takes another 2-3 weeks. So again, that adds to costs, an additional boost to inflation, more pressure on supply.
So it's like following the money flow, following what will impact those prices.
Yeah.
And technically speaking, you can, with the commodities side, so let's say you're tracking coffee as an example, you can get quite specific, almost not easily, but at least you can get very specific of what to look for, where to track, if you wanted to do the research.
Yeah.
Plus, I'm sure there's probably a lot of services that can provide reports, etc. nowadays. Just like you had done, I'm sure there's plenty of outlets available now.
Absolutely, yeah. I mean, a lot of the major banks do them. A lot of the commodity brokers provide them as well. So definitely.
What was the process like though, from transitioning from the pits and the commodity exchanges into electronic trading?
Yeah, so I mean, for some guys it didn't work very well because sort of they were big traders and they might have a big position and they'd be sort of offering more to keep the market down because they were short. And a lot of the brokers would know that they didn't want to sell that, so they wouldn't really show that to their boobs, that size was there. Because they were just trying to hope that other people would come in and sell so that they could take their profits. But on the screen, it changed because instead of having access to either in commodities like 28 companies basically processing all the coffee or cocoa for the whole of the industry for London, and obviously there's New York as well. And then on Life you had 2,000-3,000 members. All of a sudden, when it went online, electronic, everybody had access. And it's great today because all the retail traders and you can be anything. You can do it part-time, you can do it full-time, so it really opens it up. But it's one of those things where you need to sort of really find yourself as a trader for that. But it does create challenges because that transition, these guys would then go onto the screen and go, okay, I want to sell 500 or 1,000. They didn't really want to do it. They was just trying to hold the market down. But because it was on the screens, all the banks then suddenly had all their guys, all these young lads that they could pay a little bit of money to on there. And they go, what's that offer there? That's 1,000. Oh, I'll take them. And so a lot of the guys that had made a good money on the floor gave it back because they was trying to trade in the same way electronically, and it didn't work.
Definitely. Yeah, definitely, that makes complete sense. I met a recent episode that actually went out last week, which will be probably like 2 months when this comes out. But Louis Borsellino, phenomenal trader from the Chicago pits, but he decided to retire rather than transition to electronic or even try electronic trading for that very reason. Because as you say, a lot of the pit traders, their edge was the pits. Like being in the pits was the entire edge. So I imagine some did try to, as you say, try and make the transition, bring that same sort of thought process. It didn't work out. What was your transition in terms of learning technicals then at that point? Where did you decide to learn?
I was always, even sort of back in the early coffee days, I mean, we still had charts and everything. It's just that they came every week or month in a book.
Yeah.
It was like, by then it was out of date, of course. So, and then sort of when I eventually went local, sort of in about 85, 86, so I was trading my own money, my own account and all that. I used to keep my own chart. So, but it was just a graph piece of paper, and every day I would mark all the trade, all the prices on there and everything, and it became a continuation chart because every month I would just sellotape another piece onto it. It was like a concertina. I'd take it out of my pocket at one stage, towards the end. It would run all the way around the pit, and it was a big pit. So it just opened up. But yeah, so I mean, I've always been sort of very interested in the technicals. I remember looking in a book one day, and it was the dollar versus the Mexican peso, and all it was just a big line of crosses going all the way up the whole page. There wasn't anything else. It was just one single column of just crosses going up because of obviously the Mexican peso weakening and the dollar going up.
Yeah.
And now it's a little bit different, but so yeah.
So were you technically then, even during that period, you were charting but just having to do it manually?
Yes.
When you were doing that, were you still looking at it from a technical perspective?
Yeah, and I mean, something that's been used for decades that we've all used is as pro traders is pivot points. So we bring them in every day, and I can go back into probably the early 80s or the mid 80s where pivot points was always being used. And you can use them on any market. So that's one of my sort of key indicators that I use for sure.
Well, pivot points, how would you define that? Would that be essentially where a large move is taking place? Or?
Well, the pivot point, so you get sort of multiple levels, but they're all based, I mean, there's lots of different ways of doing them, but the classics, so basically you take yesterday's high-low close, you divide that by 3, and that will give you the pivot point. So I always think of that as a neutral point. Okay. For the market, and then if it starts to move away, it becomes bullish. If it starts to move lower, bearish, obviously. But then it will create another series of resistance levels and support levels based on the previous day's ranges and the high lows and things like that. There's a set formula. There's actually, if ever you want to look at them, you can go on if your system doesn't provide them for you. A great website. It's actually called www.pivotpointcalculator.com, but you just put all the data in there, and then you can it'll bring them out, and because you can do intraday ones, but you've got to obviously calculate them for yourself. You can do weekly, monthly, so there's lots of different ones. Most of the systems will just bring on probably a daily one.
No, that makes complete sense. And it's such an interesting transition because so far we've spoken to a lot of traders who may have been in the pits, but then they kind of stopped there. They didn't transition from there. So it's been great to speak about that transition and sort of moving on. What's interesting, though, that you did highlight is the fact that before, a lot of the trading was done more primarily by the institutions, banks, and large investors who had capital to be able to trade through one of those entities. While now, as you say, anyone, part-time, full-time, anyone can pretty much open a trading account. And I knew it was a topic that you want to discuss, and I think it's a fascinating topic. Is it too easy to open a trading account nowadays?
Absolutely. I think, everyone can cheat and Google the answers, but at least give people a little questionnaire. Okay, what does it mean to buy? What does it mean to sell? What is the dollar? And you can make it as simple as possible, but at least have some sort of an entry to make people think about what they're doing. You see all the brokers with all their warnings, 72, 75, 80% of people lose their money at trading. And a lot of that is because they just think because they can open a trading account, they're almost guaranteed to make money when it couldn't be further from the truth.
Do you feel like as well, a lot of people like the idea of trading, and especially the way it's promoted now? You might be able to speak on, to be fair, like if that's always been the case when it came to trading and how it's been seen as this sort of not get rich quick or at least like Wi-Fi printing money from your phone sort of thing. Even before, let's say, social media and being able to do it from your phone, I'm sure people were doing it from desktop at home. But was that a similar message that's always kind of been there when it came to trading and investing?
Well, I mean, on the trading floor, the only way you got into it is by knowing somebody, really. But when it went electronic, and of course that opened it up, but then you got this massive growth of new brokers coming through as well because they could see the opportunity. And where it had that second real boost, the first boost come probably from Bitcoin when that really started to get going, but the real boost came during COVID. Because obviously COVID, everyone was shuttered at home. There was nothing that they could do, but they wanted to try and generate some revenue. And it was funny. I read something online that the US brokers, sort of this helicopter money that the US government put into everybody's bank account. It was $1,200 the first one, and the brokers were saying in the US that they've never had so many $1,200 deposits going into trading accounts.
It doesn't surprise me at all, because it is such an interesting thing that COVID. It makes sense why it would happen. Like you said, everyone's at home. A lot of people weren't working. They wanted to make a side income, learn a new skill, and trading is one that just makes sense because it doesn't require, stock. It doesn't require like a physical premises. You can do it from home, and fortunately, unfortunately, the barrier to entry is just almost nothing. Almost at this point, the minimum deposit on some brokers is like $50. For example.
It's crazy,
and it's a beneficial thing in one sense that the opportunity can be open to anyone.
Yes,
but it is a negative because I think it leads to, as you said, like people who have no knowledge of trading trying it out, like taking a punt on trading, which I think is can be a very dangerous mindset. Because I understand, because I was saying how, like, I've said a few times on the podcast, if you get into trading to make money, it's not going to work out for you. But someone did point out, like, it's fine to get in that way, but as long as you change and actually get passionate about the markets.
Yeah.
Quite quickly, then it's all good. Because it makes sense. Like, why else would you get into trading if it wasn't for the money at all? So I understand the first law is could be the money, but afterwards you need to pivot to actually enjoying the market. No doubt, 50 years is because you love the markets.
Yeah.
And the passion for the markets is there. Plus the money's great, but the money's only there if you're passionate about the markets and able to stick to everything that you have to stick to in order to be consistent.
Yeah, and so when I mean, the money is great, and but it should always be about just trying to become the best trader possible. And if you can achieve that, then the money naturally comes out at the end. If you focus on the money, you make it 10 times harder, 100 times harder than it needs to be.
At one point in your journey, you were working as a market maker, if I'm not mistaken.
Yeah, I've done quite a lot of that. I mean, even before the markets went electronic, we used to price into market spreads and things like that on the floor. And then when they went electronic, I ended up going out to Italy and being a market maker for an Italian bank for 4 years there. And even when I come back, I've been a sort of a market maker, liquidity provider on some whole mass of different products. So hot rolled coiled steel, some really weird ones, iron ore. As a company, we've got traders in to manage some of these, wheat, cocoa, gold. So yeah, a whole variety. But I enjoy that. Market making is different though. Because when you're trading, you're making those decisions. This is my entry, this is going to be my exit, this is going to be my stop loss. But when you're market making, you don't get to decide your positions. They're given to you. And then, of course, you have to manage them.
That was the interesting thing, to be fair, in terms of that. I found it fascinating because I didn't think about it in that way. But like market making, this is something you said there, market making teaches you discipline. You're constantly pricing the market and you don't get to choose your positions. As you just said, they're given to you. That forces you to think ahead and manage risk meticulously. I was worried I won't be able to say that properly. We managed to get there. But can you talk about that in just a little bit more detail in terms of that your positions are given to you. So how do you manage risk in that scenario?
Well, so there's different ways, and there's different ways of market making. I mean, what the majority of market makers will do is they will just hedge themselves all the time because they want to reduce that risk down as close to zero as possible. So they will make the price, the moment they get hit, they're going into another market to hedge themselves. I never used to do that because I've been trading prop my own, I've been trading my own account for 38 years. So why the exchanges liked me doing it is because I would take the positions on and I would manage the positions. But for example, in Italy, when I was market making there, so I started 3 weeks before 9/11.
Wow.
As a market maker. And of course, you know what happened after that. So the first thing I did every morning when I got in, I was market making the mini contract. This is what I like about the futures now, is they're sort of got wise to the fact that you can have the full size contracts for the institutions, but you can have the minis and the micros for the retail traders and the smaller traders. They don't need to risk a lot of capital to get into the futures these days. And of course, you've got all the CFDs where you can basically go in with whatever level you want to. So where that came in would be, as I say, so a lot of them would hedge, but I wouldn't do that. So because it was just after 9/11, the markets became very bearish. So because I was trading the mini, I knew that everybody, the market maker I was in, they had 50,000 online customers. And I knew that all they wanted to do every day was just sell to me. So the first thing I did every morning was I would sell the big contract as soon as it opened, knowing that I was going to get sold at a slightly lower level and constantly for the rest of the day, the smaller contracts. And it was a 5-to-1. So every time I bought 5, it was equal to 1 main contract. I would sell 3 lots there, so then I was quoting in 15, so I'd start to get hit on my 15, prices would be going down, then I'd go in and sell more, and then I would just keep doing that. But I would always go short first, so when people were selling to me, all I was doing was taking profits. And I was always trying to leave myself an additional few short as well. So, if I've sold 3, which is equal to 15 minis, the moment I bought back 10 or 11, as the traders were selling to me, I'd go back in and sell again. I always wanted to have that additional short position. And sometimes I'd run them for 120, 150, 180 points, the odd ones that I managed to get
especially
short
during
of.
that volatile
Exactly,
period.
yeah. I mean, it was very volatile, but but it was a good experience and it worked really well, yeah.
It's an interesting topic, though, because coming into 2025, as you've already mentioned, we have the Ukraine war still ongoing. We have obviously the Middle East tensions that constantly are up and down. We have markets at all-time highs across the board, and yet there is this tension and this thought of a crash.
Yeah.
Right. This volatility that is right now sky high, but on the up, but it could equally very easily flip. And going into 2025. What are your thoughts as someone who's been through these market environments before? Like, what is it that traders should be focused on, regardless of whether it happens or not this year or next year, or if it happens at all? But what is it that traders should focus on when those volatile moments are happening and when things feel like a bubble and that a crash could be happening or on the horizon? What is it that traders need to be focusing on in those moments?
Let's take a break for a minute there, guys, because I want to tell you about our sponsor, TradeZella. TradeZella is the #1 trading tool for all traders. It doesn't matter whether you're a crypto trader, a futures trader, or a forex trader. Whatever trader you are, all you do is connect your trading platform directly with TradeZella. It automates and makes your trading journaling so easy. If you want to be a profitable trader, you need Trading Edge, and that is exactly what TradeZella does. It allows you to identify edge, maintain your edge, and optimize your edge by automating your trade journaling, in-depth analytics, backtesting, bar replay, and so much more. Now, WOR gets you 20% off your yearly subscription with TradeZella. So use WOR for 20% off your yearly subscription, or Riz10 for 10% off your monthly subscription. The link is in the description below. Let's take a break for a minute there, guys, because I want to tell you about one of our sponsors, Alpha Capital. Now, without our sponsors, it's not possible for us to host such incredible podcasts around the world and get the level of guests that we are getting. So again, thanks to Alpha Capital for sponsoring the podcast. Now, Alpha Capital is one of the best prop firms in the industry. So far this year alone, they have done over $50 million in payouts, which is absolutely incredible. They have the very best infrastructure in place for longevity, from an in-house broker so they can offer the very best trading conditions and platforms that all traders love to use. They're still able to offer services to the US as well, so the US traders can still trade with them on particular platforms. They have institutional experience, so they know how to manage a prop firm correctly and have such an incredible team on hand. On top of which, they have both a pro and swing plan. So depending on your style and strategy, you can choose which one is best for you. Now you can use and get the highest discount available at anywhere using Riz25. So that's RIZ25 for 25% off all challenges. The link's in the description below. So So let's get back to the episode.
Well, and of course we've got Trump 2.0 coming in January the 20th, and he's this time he's really going to hit the ground running with all these executive orders and pushing things through Congress and all that as quick as possible. And he will do as much as he can in the first 2 years as well, in case he loses control in the midterm election. So he's going to really pump it in those 2 years. And of course, the things I call it Trumpflation because he's with tariffs that's going to increase costs. With in the US getting rid of all the sort of unregistered immigration that he can find, that's going to reduce the workforce. So it's going to put more pressure on wages, and of course. Not only that, but tax as well, because if Harris had got in, she wasn't going to renew what he signed in the first time he was in, giving all the corporate tax reductions and all that. Whereas he's either going to extend them or possibly even reduce them even more. And of course, he's likely to water down regulation even more as well. So, you've got to take Trump really into account. Think of what it happened last time he was in. And then probably multiply that up a little bit. But interestingly, he could be the peacemaker. He really could become the peacemaker. Obviously, he's got a relationship with Putin even before he became president the last time because of business that he's obviously involved in. And then in the Middle East, I don't know whether he can solve that one. That's always a powder keg that's been going on for decades, if not longer. But I do see, because especially if Trump's likely to threaten to either reduce or cut off a lot of the aid that's going to Ukraine, whether it's weapons or whether it's financial aid. And if that happens, and then what's going on with Putin, I think there could be the opportunity for negotiations, especially as Ukraine are struggling at the moment in that war. Especially now Russia's getting North Korean troops on their side as well. So that's definitely something that I'm really sort of focusing on, because Trump, he's going to have an impact right across the world. I love the old saying, when America sneezes, the world catches a cold. But, whether whether there's going to be a crash or not, what is a crash these days? It's so short-lived. It's like life, okay, because I'm old, maybe it's because I'm old, I think life moves much faster now, or it's just tech or whatever, or whether it does it for everybody in the world. Just moves that bit faster. But it's like the governments and the central banks no longer want us to go through a recession or a depression. They want us to have that feel-good factor. So what do is they come in and they pump all this crazy electronic money into the system just to ramp up the actual asset values again. And put them at record highs. When they did that in 2022, they ramped up quantitative easing. I always think quantitative easing is the easiest solution, but not the best solution for central banks. But that's another conversation. And so they push all these prices up. And of course, all they do is they just go on electronically, give themselves as much credit as they want to. Imagine if we could do that. Imagine what inflation would be then. You'd be 1,000,000+%. And I just think it's out of hand, and it's going to be interesting to see what Trump does, because he's not a fan of Powell, although Powell will finish his term. But then, I'm sure that Trump will bring in someone that is more aligned to Trump's values, because, you can say that the central banks are independent, which they are generally financially, but generally, the chair or the top two, shall we say, in each of those, they're given their positions by the government anyway. So there has to be a little bit of...
There's always that case, isn't
yeah,
it? It's like keep them close, as they say, keep your friends close. But it's interesting you mentioned that, because especially with, I think one thing you said previously in terms of the 2008 global financial crisis, is it wasn't about making money. It was about surviving the volatility. And that was the challenge, but it was also an opportunity. So rather than trying to make money, it was more so making sure you survive, so keeping your account, because no doubt there was like so many traders who were blown out by that. Even the COVID crash, as you said, is a very brilliantly put in terms of we're not seeing these crashes really. We're seeing the crash, but we're not seeing the recession. We're not seeing the depressions. Even though everyone's always talking about it, it's always circulating in the air. We saw that crash and then a rebound straight after.
Yeah.
And so it's interesting. But I no doubt in that crash, so many people lost out again. And the amount of people who made money during COVID and ended up just losing it all after, because for them it was easy during a bullish market to do so. Then when it came down to managing risk and managing an actual short and long position, they couldn't do it. So I love that statement in terms of actually it's about surviving. Rather than focusing on making money, it's surviving. Which, to be fair, is another one you mentioned, which is before I enter any trade, I ask myself, where's my exit? Risk management isn't optional. It's the foundation of successful trading. Which is interesting because a lot of people probably focus on the profit first. Right?
They do, unfortunately. It's for me, when I'm going to go into any trade, it's how much is that going to cost me if I'm wrong? And that's really important, my entry level and where my stop loss is going to be, because that's the only way I can work out my position sizing. Mm-hmm. If I don't, I can make this. Can you make that? It's fine. You need to work that out. But afterwards, it's always a case of how much can I lose in this trade, or how much am I prepared to lose in this trade? So if I'm going to go in and I'm going to buy it at a certain level, where is my stop loss? Maybe it's a technical level, and if it goes through that, or a pivot, maybe it's a support line, whatever, or previous lows from the last week or two. But when it goes through there, that's where my stop loss needs to be, or Fibonacci's or something. So I've found my stop loss level. I've worked out how many ticks that's going to cost me, pips or points, however you want to phrase it, when I'm going to be wrong and get stopped out. Once I've got that, I know how much I'm going to lose per contract. Then I can work out how many contracts I can have. Once I've done that, then I look, okay, now if I'm fortunate and I get filled and then it starts to go up, where is my exit going to be? I deal in zones, so I don't go all in at one level. I always say to people that I'm training during my courses is 85% of your trades are going to go against you before they go for you, if they're going to go for you. Yeah. So I thought, why not take advantage of that? So instead of going all in at one price, what I do is I split my trade into three. So I've got where my support level is. This one's going to be as close to the support level as possible. And then I'm going to work out how far away from that support level I want to go. And then this is my midpoint as well. So I just come in with three sets. And then sometimes, instead of just having, so I can take the average as my stop loss, or I'd have three stop losses. And sometimes I'll do that because this one might get triggered, possibly even these two, but this one's that little bit further away. So sometimes this one can survive, so I'll keep a third of my position and the market reverses and I can still end up taking a profit on that trade. If I get stopped out on all three, well, that's just part of trading because we're never going to win every trade. And then when I'm taking my profits, I'm the same thing. I'll have a zone where I want to take my profits. So my minimum risk reward is 2 to 1. Because that way, even if I'm only right in 50% of my trades, I'm still making money. And then once it gets to that 2 to 1, that's my start point, and then I'll see how strong it is when it's there to how quickly I should be getting out of those positions. Otherwise, I just feed in. Even though I feel that it's probably going to go further, you never know when the market's going to turn. So I will feed into that. And it's very important. We always focus on stop losses and that, quite rightly, but you've got to know when to take your profits as well. You need the good trades to pay for any bad ones.
You think sometimes traders just leave the TP open-ended?
Yeah.
Just in case on the unlimited money path is by just leaving it open-ended, but in reality they just get attached to that trade, don't end up managing it well, and it, a lot of the time turns back to a break-even or a loss.
Yeah, and I mean, you can always put a trailing stop on so that it's tracking the market to protect some of that as well, because you get into that situation where the market's rallied And you think, and it's just coming off a little bit from the top. Oh, why didn't I sell some? Because it was up, say 92s, now it's trading 87s. You go, why didn't I sell some at 90? And suddenly it's trading 85s, 83s, 82s. You think, why didn't I just sell some then when I just thought about it? I should have got out of something at least. Now it's trading 80s, 75s, and it's coming down. But of course, because you've seen those higher prices, you're more reluctant to actually start to sell and get out. Whereas if you've got a trailing stop on, it technically, the moment it breaches that, it's going to do it for you. So it takes that decision making away from you again. Or you can just put a hard stop in somewhere just to protect some profit. I really hate break-even trades.
Really?
Yeah. I mean, with a I mean,
Why?
If you know any of the traders that I've trained up, that where we've had big trading rooms in the past, they'll tell you how much I hate them.
I feel like it's a waste. Like the whole point is
absolutely. So here's my level to go in. Here's my stop loss level. I was prepared to lose this money when I put the trade on. Now, because the market's a little bit in my favour, suddenly I'm not prepared to lose money anymore. And what am I doing? I'm bringing the stop loss closer to the market. And, protect some profit, yeah, fine. But break even, no, because what are you getting out of that trade? Nothing. And the market loves to do a retest. The market loves to go up a little bit and tease you. Come back to test your resolve and the resolve of all the other buyers. Are you really there? Do you really want this market? And then they all come back in. But then all you've done is just pass that opportunity on to somebody else. And of course, the market ramps up and they get the profit, not you.
I love that. Because this is what the podcast is all about, different insights. And one thing that you just mentioned there, though, in terms of like testing the resolve of the buyers and the other buyers in the market. One thing I've noticed when I spoke to Nick Leeson, spoke to Jason, spoke to even Paul Scott, or Lewis, to be fair, didn't go to electronic. But I imagine the other three were, but Pip Trader's gone electronic, and obviously similar to yourself. Even though, as you mentioned, people who tried to take the same mindset, exact same mindset, didn't work out for them. But do you feel, though, when you're looking at price levels and zones, as you mentioned, a part of you, is your mindset still looking at it from a perspective of, is this considered a cheap place to buy or a good place to sell? And when the market is retesting those sort of levels, are you still treating it as if it was not in the pits entirely, but the same ethos of, is this a good position to be buying from? Like, is the pricing level, one that could be considered a good buy level to then be able to take out? Because that was one thing I took from Paul Scott and Jason as well. A similar mindset of like, they're not trading like the pits, of course, but they're treating the levels that they're using, especially Paul, to be fair, that's his whole thing, is just understanding, is this considered cheap and therefore it should be bought, or is it considered expensive and therefore should be sold? And I just kind of got a little feeling from that when you were saying how they're testing the resolve of the buyers. Is that anything there? Or?
Well, I mean, I sort of never look back at sort of like my open outcry days, the physical trade. I just focus on what's in front of me each day. Every day is a new day. But, you get used to, again, for guys that are just getting into trading, it may be experiment with all the different asset classes. Find out what's right for you. That's very important, because if you end up trading the wrong asset class, it's not going to work. You've got to get a connection with something that you can have a little bit of success with, and then you need to build the consistency from that. But when you're going into that asset class and you've got to find that one that's right for you to start with, then it's how you progress from that. But I think that the asset class has to be the nucleus, and then you build everything around that. And then, it's sort of, if you're going to use technicals, fundamentals, with 50 years, I've got both. So, my fundamentals always give me my bias for which way I want to be in the market, long or short. And then I'm going to line that up with the technicals when they come. So, if I'm bullish and the market wants to come down for a retest, then I'm happy to go in as long as I've got a level in mind or a support level that I can enter. And then when the market goes up, as I say, I start to sort of stagger selling out of my position. Then if the market does come back for that retest, I'm not thinking, oh my God, I need to get out of the rest of it. As long as I still believe in that level, I will actually buy back what I sold at higher levels and buy that. Okay, if it goes down and stops me out, it hasn't really cost me any money because I've already sold part of my position out at higher levels. If it doesn't do that, and then it bounces again, then I'm back into the same position doing it again. So, the market does love to retest levels. The markets are very symmetrical when you look at them. There's so many patterns, and everyone, you talk to analysts, everyone's got their own ideas and different ways of looking at charts. But I find that something that I find very interesting is long candles. So where you've had a big move.
Yes. Mm-hmm.
Maybe on a 30-minute or a daily, something like that, you've got this big move. And then I find that, okay, so then the market might go a little bit sideways because it's working out whether it should go again or stop. But when the market turns and starts to come back down, so it's had a big rally, bit of sideward action, now it starts to come down. Sort of one of my triggers is where all this sideways action is, the low of those little smaller candles. When it breaks them, I'm quite happy to sell it. And the reason for that is because I think with a long candle, all the action's been done, all those prices have been cleaned out of the order book. So when the market breaks back down, there's nothing to defend. And it just goes into like a black hole, a void, and then it comes all the way back down quite often, again to meet the start point of where that rally initially started from. You look back on your charts, you'll see it so much.
No, I've the interesting thing when you were just explaining that is you can see it physically. If you've been trading a while, you'll be able to picture exactly what you're describing, because you see that. That's the beauty and the curse of the markets. Is like there's so many different ways that the markets can print themselves, but as you said, there are patterns. Someone said it this morning, Axel, he said, what did he say? He said, I think it's a regular saying, to be fair, in the markets, but essentially it's like, what was it? There's something like it rhymes, like the market doesn't like repeat itself, it's not identical, but it rhymes, there's a rhythm to it.
Yeah, absolutely, yeah.
And that's one of them though, for sure, where you see that huge impulse. Either we consolidate, collect more buy orders, continue, or we consolidate and then we end up falling. And that black hole analogy makes complete sense, where there's no orders left, so it just returns to origin. If you and a lot of the time, I think because of then, the revenge traders and the traders who missed the original pump, they start to buy at that original level again, and then we dump further.
Yeah.
Just going straight through them. Just to go backwards, just ever so slightly. Sorry, I forgot to ask you about the market makers. Kind of going off that point, is that everyone has this assumption, I say everyone, but there's a huge assumption in the retail space of market makers are targeting your stop losses, right? That's what they're trying to do. They'll see your stop losses, and that's what they're always trying to do, target your stop losses. Any truth, it was just like a rumor in the space that they look to point fingers at.
Some of the biggest companies that do some of the market making, they are adding liquidity to the markets, but I would say some of them are predatory as well.
Okay, so it's like a balance.
Yeah,
there's good and bad as well.
Yeah, I mean they're adding, but they're in there to make money. So if they can see those opportunities, they're going to take advantage of them. And again, it depends where you're trading, because if you're trading CFDs, then you're either trading against a broker or you're trading against their market makers. When you're trading the futures and the options, you're just trading against other traders. Mm-hmm. So it depends which route that they're taking and where they're seeing that.
Well, that's what I wanted to ask you, actually, because it's such a big thing now, especially for retail traders. A lot of retail traders now, not only, I would say, are coming in, they're not really trading a lot of personal accounts nowadays, like on straight to brokerages and live accounts. They're going through funding options, which now has created this sort of split where do you go futures or do you go CFDs? What would you say that traders should be looking out for? As you mentioned, to be fair, I think it's a fascinating topic of finding your market. Find your market first. Find the asset class that suits you first. And we don't really hear people talk about that often. Is there specific things that a trader should be looking out for in terms of what factors that would suit them, or factors they should be thinking that would apply to that?
Well, trading is a unique journey for everybody. There's no two traders. You could be twins and you'd still have slight differences in the way you approach things, I think. And it's such a personal thing. So it is finding that asset class that you connect to, but also your risk appetite as well. The reason you've got to find the right asset class is because the markets move at different paces. Now, FX traders get really irritated with me sometimes when I go, FX is the slowest of all the asset classes. Like, what do you mean? What do you mean? It can't be. I'm like, have you ever traded NASDAQ? Have you ever traded DAX? Have you ever traded crypto? You know, they're completely different markets, the speed that they move. Okay, the stocks, they trend, but they just keep going and going as well. Now, there's opportunities in all of them, but you've got the slow-paced markets, the medium-paced markets, and you've got the fast-paced markets. And again, you've got to work out which one's right for you.
It's so true, because that's one thing that a lot of traders don't look at is their personality, I've found. And I think it's interesting because, you know, a trader who's not patient at all will still sometimes, a lot of the time, force themselves to try and be a swing trader, for example. And I get, what are your thoughts on that? Do you think people can change? You know, that sort of thing where they can change, that if they're not patient, but they can train themselves to be and therefore swing? Or do you think that some people are just embedded with certain personality traits and they should really try and focus on their strengths?
I think you adapt over time, or you can if you're willing to, and you've got to be willing to. You know, I used to train big groups. You know, I've done so much training. And I had this one guy, he used to be a surgeon, and he was doing my course, and he was just scalping. And I'm like, you know, you shouldn't be doing this. It's not going to work. You know, I'm not a fan of scalping. I mean, as a pro trader, I can do it. But I think as a retail trader, what happens is you go in and you take all these little profits. You just accumulate in little winners. But the moment the market starts to go against you, you don't get out. You stay in the position because it's going to come back. And I find that what happens with scalpers is you give back all the money you made in all those little trades in one trade. Because it becomes a position then, it's no longer a scalp.
You end up going against your original thesis and just holding.
Yeah, but it's also risk reward because, you know, if you're only scalping and making 5-6 ticks, are you prepared to have a 2 or 3 tick stop loss? Of course you're not. So then your risk reward goes out the window, and then your ratio of winners to losers completely changes as well.
It is interesting because I think a lot of traders nowadays I see it predominantly a lot of people trying to scalp, and I don't know what's incentivizing that, or is that something that you've noticed is kind of a common occurrence?
I think there's a lot of social media, a lot of YouTubes where these guys they find it an easy way to demonstrate how to trade, but it's not a good way to trade. And then what happens is that everyone tries it for 2 or 3 months, and these guys get a massive following, and then all of a sudden they realise that scalping's not the way forward. We call it picking up pennies in front of the steamroller. Because, you know, you can get them and then there's always that one you can't quite get your nail under and then it's splat. And that's the way we look at scalping, really.
Interesting. So would you say you predominantly sort of day trade, swing trade?
I'm intraday trading. Again, you know, I've got different strategies for different asset classes. You know, if I'm trading oil, for example, I tend to do spread trading, calendar spreads. So as a sort of, you know, where I'm going across the curve. And the reason that I do that is because I can slow the market down. I get to determine how much volatility I want in my trade, how much risk I want in my trade. It doesn't mean I make money in them every time, but I can slow the market down, or I can actually speed the market up if I want to. You know, that's why when I do my trading courses, I always teach people how to trade on the back of the futures and the options, but they can easily sort of migrate that and interpret that into trading CFDs as well. They can go whichever way they want to. And you know, it's surprising because I usually go to and talk at the IX shows. There was one last year, and I'll be doing the one again this year in April. And you get all the traders come up, and they're all talking to you about how they're trading and all that. But all they really want to know is how I trade, or not just me, but all the experts that go there. And so, you know, they'd ask you. So I'm very open. I love to share what I do and how I do it. You know, it's no problem to me. Which is why I do the courses. And so I'm going through it and I'll explain it. And it doesn't take long. And then all of a sudden there's a deadly hush. And I go, yeah, any questions? And they go, is that it? You go, well, yeah. You know, if you look at all the good pro traders, they've got the simplest of setups. Everybody tries to overcomplicate trading.
Do you feel like the overcomplication, is that simply because they assume something as hard as trading needs to be complicated?
Yes. Yeah.
What is it that traders should probably focus on then to keep it simple? Obviously, as you know, and as we know, anything can work. But what would you specifically say that simplistic things that you use or that you think that others should use as well?
It's coming. Again, it depends how you're going to trade. But with technical analysis, is you don't want 100 different indicators. You don't want 20 different chart types, or you just want to keep it very simple. I've got 3 different charts that I use, but for different purposes. And then I've got maybe 2 indicators that I use, maybe 3. I'm a big fan of pivot points, as I've mentioned. I like Fibonacci for retracements. I will use MACD with a histogram as well. I don't really like moving averages very much because they're too lagging for me. I don't want things that are lagging. And then I use 3 charts. I use a candlestick for all my analysis, for my trends and everything. And then I will use point and figure to identify support and resistance levels. And I will use Heikin-Ashi for market sentiment.
Interesting. Point and figure, I've never heard anyone use.
Noughts
I remember
and
when,
crosses.
yes, I remember. I remember when I was looking at some videos that you have out there. I remember seeing that, and I was like, okay, I've got to ask him about this. But how come you use that for support resistance? And what do you take?
It's one
from
of the
it as well?
oldest chart types in the world. Point and figure. It all started off where traders would write 21, 22 and all that. Then they started using arrows for up and arrows for down for all the different price changes. And then it just got converted into noughts and crosses. I just look horizontally. I don't put any trend lines on because they're too easy to find and I don't think that they work very well. But if all I'm looking for is where market rejects levels, and it can be over time. And I created a trading signal that I use from that. So I just look horizontally where the buyers and the sellers are in the market. Now, the thing about point and figure, the true point and figure, is it doesn't have any time element. It's only pure price action that actually populates anything onto that chart. Some systems will allow you to add time into it, but for me that's wrong. It shouldn't.
You think it should just be price?
It's just got to be price action.
That's very interesting because that is one of the debates that you see is time and price. Well, there's the debate of both, of course.
Yeah.
Then there's the debate of either side, and I find it fascinating because some people will make the argument that only when it's the right time should you be executing, but then I'm sure yours is when it's the right price.
Yeah. And when it gets to trading, don't just jump into the market. Set your price and let the market come to you, because that's going to be a more of a high probability trade. If you've got this FOMO where you keep jumping into the market, you're just giving away the edge all the time. But if you're patient and you mentioned patience earlier, it's such an asset. It's one of Buffett's famous sayings is, the markets are a way of transferring capital from the impatient to the patient, and I love that. And it's so true. When I was younger, I didn't have any patience in life, but I learned to have patience in trading. Because then also you don't grab your profits if you've got patience. You'll let them run more. When I'm in trades, I cover over my P&L. I don't want to see my P&L. Really? I've got all my stop losses in, so I know I'm protected, but I don't want to get tempted. If I see my P&L and I see it starting to grow, I think, oh, that's nice. I think I should take that now. And then whoosh, up goes. I could have had 3-4 times as much out of the trade. So for me, once I've established where my entry, my stop loss, and where my take profits are, then that's it. I mean, my take profits is always just a very small part of my position, or it's a price alert, so that when it gets there, I can reassess, reanalyze, and then decide how quickly I want to get out of that.
When it came to electronic trading, creating your edge in the first place, what would that process look like? Because as far as I'm aware, without a trading edge, like a true profitable edge, you can't be profitable. Even if you have the best risk management, the best psychology, you need that edge that essentially the other things will be built upon. Is an edge essentially data? You need to have data on your particular technicals, wherever it may be, to then be able to define that this is a profitable edge for me?
I mean, possibly a degree. I think for me, because even when the markets went electronic, I'd already been in the markets 28 years. So it made it easier for me because I already had all that experience. So it's just a matter of just how I translated that into the markets, what I used. And for me, it was the technicals. But because I had sort of a wealth of all that fundamental knowledge as well, as I say, that gives me my bias. And then what I'm looking for is the technicals to align with my fundamental view. You know, it's again, when I do all my courses in the mornings, I always do theory. So I always try and instill fundamentals into the guys as well. And then in the afternoons, we do the practice sessions, so they get the best of both worlds. You know, they're implementing their sort of theory, if you like, immediately in the markets in the afternoons.
Okay, so like in terms of edge then, the edge really is derived from understanding the fundamentals for the direction.
Yes.
And then it's simple technicals to be able to execute on, manage a trade, you know, have your stop loss, how do you take profit, and then just managing alongside the fundamentals. So you trade quite a variety of markets.
Yes.
So is it the same across all of them in terms of fundamentals being the base?
Yeah. You know, what I always say is the fundamentals that are going to determine the trend, the volatility in the market. We use the technicals to visually see that what's happened in the past, but also we can use the technicals to assist with our timing for our entries, our exits, and obviously where to place our stop losses as well.
What's it in terms of a trading plan? In terms of what does that look like? What should a trader be looking for when it comes to making a trading plan?
You see, I think there's two parts to a trading plan. The first bit is the financials, and you know, if you're just getting into trading, then you've got to treat it like a business, number one. And before you actually go into that business, you've got to work out how much of your capital you're willing to invest in that business. And because it's so personal, because it's you can get carried away with that. So I always say to guys, think about how much you want to, you know, of your capital, how much you're prepared to invest in yourself to become a trader. And then put that into an Excel sheet. And then if you have to top up your account anytime, work down. You know, if you get to 50%, it's a little warning sign, something's not right. If you get to 0, stop trading. I always say count downwards, because if you start at 0 and you go, I'll just risk $3,000, you get to 2.5, you go, I can afford it, I'll go to 4. You get towards 4, suddenly it becomes 5, then 7, then 10, and suddenly all your savings are gone.
That's very true, very true. And I think, unfortunately, a lot of traders don't have savings in the first place, as we mentioned earlier with the barrier to entry.
Yeah.
Unfortunately, a lot of traders, they're a lot more emotional with their trading simply because of they're desperate for money from trading.
And you know, this leads to 2 points. One of them is, you know, if you're going to learn to trade, make sure you've got a steady income coming in. And don't always just give up your day job the moment you can make more trading. When I was at the IX event in September, one of the questions I asked everybody that was there, if the moment you can make more at trading than in your day job, would you give up your day job? And there was loads of hands all went flying up. And I went, you're wrong. You shouldn't do that. And so there's a big lot of shocked faces, you know. What do you mean? And I was like, listen, you know, because the point is, why are you being so successful at trading? Because you want to make money. You don't need to make money because you've got a steady income that pays all your bills. The moment you lose that steady income or you give that steady income up, you go from wanting to make money to needing to make money. And again, that's why a lot of people fail. Now, when you talk about being undercapitalised, which obviously a lot of guys enter in the markets, you know, either save up more or considering some of these trading challenges where you know, if you can pass the trading challenge, then you move on and you'll get a live funded account. 2 of the courses that I provide, I actually include a free trading challenge with them. That's done by Nordic Funder because, you know, I think their one's quite fair. When you look at the trading challenges when they first come out, you had 30 days to make 10%.
Yeah.
I mean, how, you know, it was, you know, I wouldn't wish that on anybody. You know, but they, over time, these guys and some of the others, they all started moving those away or removing them completely to make it more of a fair challenge.
Do you feel like when it comes to taking those sort of challenges, though, that traders have to 100% be aware that they need to have some form of edge that would dictate that they could pass that challenge? Because I feel a lot of traders, again, are coming to these sort of challenges and thinking it's, there's such an easy route to make more, have capital to then make more money from the markets, and yet they've never really had any consistency.
No.
They're using these accounts as like some form of...
And again, the key word, consistency, is, I think where the trading challenges are useful is if you're thinking that if you feel that you're almost ready to trade live, hopefully you've been practicing on a demo, you almost feel that you're ready to trade live, then a trading challenge can be a good way to prove to yourself that you're ready to trade live, whether you're going to use your own capital afterwards or you get a funded account. Because obviously there's restrictions on what you can do, what you can't do, maximum drawdowns and all that. So again, it does instill a little bit of discipline into the trading.
It's like having one of those risk managers back in back in the pits or in the institutions. One question I like to ask guests is, if you were, what was one thing that you wish you knew about trading before getting started?
I don't think there is for me because, it's because of the way I got into trading, it was very different than probably most. Working for the exchange, then a small broker, then a big, and then ending up going local for myself and trading my own money. So I don't think I've got an answer to that, to be honest with you. I would say, apart from obviously the money, the thing that I value the most in my career, especially from the moment that I went local and was trading my own account, was time. Getting that work-life balance. I only used to work mornings. I would make my money in the morning, I'd get on the train, I'd go and pick my daughters up from school, the rest of the day was family. Apart from Mondays when I used to go on the golf course.
But then when you went local, was the problem that then you were spending a lot more time trading?
No, that was when I got that freedom.
Okay,
that was when you're working for a company. I love the saying, your salary is a bribe to give up your dreams.
Yeah, no, that is a true saying. That is a true saying. It's unfortunate, but it's good to hear that you made that transition. Was there any changes in your trading or any challenges you faced when going from managing capital to then trading your own capital?
Yeah, I can sort of empathise with everybody that's getting into trading, because when I started trading, even in the mid-80s when I put up my own capital, I only started with 10 grand. So I could only still trade a very small size position, 2-3 contracts to start with. I had to grow that over time. I do understand for people that are coming into the industry, it's why I can relate to them and I can show them from the ground up how to, I always say when it comes to trading, you've got to learn first how to protect your capital, then how to make money.
Fortunately, people do the other way around, right?
Absolutely, yeah.
And that's normally why they end up in the position they're in. But Chris, it's been an absolutely incredible episode. I'm sure we can go on and on. I'm hopefully going to organise like a round table. The links for Chris will be in the description below, so make sure you check those out as well. There'll be other episodes on screen. Drop a comment with your biggest takeaway from today's episode. And until next time, everyone, take care.